Good day, fellow lizards. Last week I said we were in an accumulation, somewhere in the boring part, and I gave you a level. I said, watch the point of control around 66K, because price gets pulled back to it and it tends to act as a magnet. Well, we tagged 66K, got rejected, and now we're sitting at 64K, going nowhere in particular. So the read is still intact, nothing's broken. But this week I want to do something different. Last time I promised you the other side of the picture, not the price chart, the plumbing underneath it. Funding, open interest, premium, and the spot tape, because price tells you what happened. These tell you whether to believe it. Let's take a look. So this is the chart. Price on top and then 4 rows underneath. Open interest, funding, premium, and spot tape. If you've never looked at these before, don't worry. Before we dive in, let me just explain what each one actually is. Because once you get them, you can't unsee them. First, open interest. This is simply the number of positions open right now. When it's rising, new positions are being opened. Fresh leverage coming into the market. When it's falling, positions are being closed. So open interest tells you whether a move has real money behind it or whether it's just the same players shuffling around. Second, funding. On perpetual futures, there's a small payment that flows between longs and shorts, and it keeps the futures price tethered to spot. When everyone's piled into longs, longs pay shorts. So when funding runs hot and positive, that's your sign the crowd is heavily long, and a heavily long crowd is fuel for a flush. Third, premium. This is the gap between the futures price and the spot price. Futures trading above spot means traders are paying up for leverage. That's an eager, greedy market. Futures below spot like we have now means the opposite. Caution. Nobody's reaching for leverage. And fourth, the spot tape. This is real coins actually changing hands on spot, not leverage. And this is the one that matters most for spotting a bottom, so keep it in mind. Now let's put it together. Zoom in on the leg from the top down into the low. Remember the Wyckoff structure from last week. Price makes its high, then sells off hard into a selling climax. Watch what the spot tape does right there. That's the biggest spot activity on the whole chart. Real coins changing hands, in size, right at the lows. That's not panic selling into nobody. That's someone on the other side of that panic, buying. That is what accumulation looks like on the tape. Now, one honest caveat, because I don't want to oversell this. That spike at the selling climax in February was genuinely big. Real capitulation. Exactly what you'd expect. But look at 2022. When we hit the FTX bottom, spot activity was enormous and sustained. Overall, our spot tape this cycle just isn't as pronounced as it was back then. The selling climax spike was there, but the secondary test was much more subtle. So the buying is real, but it's not screaming capitulation bottom across the board. That tells me 2 things. 1, this is accumulation. But 2, we may not have seen the final, violent flush that usually marks the exact low. So don't read this as bottoms in, up only. Read it as the structure is right, the process is underway, and it may still need one more scare to finish. Now, open interest. Notice it drops into that low and doesn't come roaring back. So the move down flushed leverage out, and the recovery since hasn't been built on fresh leverage. It's been quieter than that. And here's the tell for right now. Funding is barely positive. Premium is negative. So at 64K, after a bounce, the crowd is not aggressively long, and nobody's paying up for leverage. That sounds bearish. It isn't. A market that grinds sideways with cool funding and heavy spot buying at the lows is not a market that's topping. It's a market that's absorbing, quietly. The froth is gone. That's what you want to see in the boring part. Okay, back to the falsifiable idea from last week, because I told you I'd revisit it every episode and I meant it. Here's the falling wedge on Bitcoin. We're still inside it, still compressing, still above the line. And on the right, the same structure on a completely different asset, decades ago. A textbook falling wedge, and the bull market that came out of it. Same shape, different market, different century. Patterns repeat because the people never change. So where does that leave us? Let me give you something you can actually use, not just vibes. Short term, we're still in the boring part. Expect 66K to act as resistance now. It rejected us once already. So a clean daily close back above 66K is what tells you the character has changed. Below, my invalidation is unchanged. lose the 53 to 58K zone and fail to reclaim it, and the accumulation read is wrong. In between those two, this is chop, and the derivatives say the same thing the price does. No froth, no crowded leverage, real buying at the lows. That is an accumulation, and it's a boring one, exactly like it's supposed to be. None of this is financial advice. We may hold positions in the assets we discuss. Trading crypto is high risk, and you can lose everything. Do your own research. Next time I want to step off Bitcoin for a second and look at the alts. There's been a breakout worth showing you, and I've got a chart I think you'll like. That one's a special coming this weekend. So for now, this is it. Take care, and I hope to see you all next time.